What's going on? Let's do a test here. Test. 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 Okay, that sounds good. What's going on? I got some Red Bull in me, got some smoothie. We're going to try and finish up this lending model today. Well, we'll get close. I don't know if we'll finish. As you know, for the past few weeks, I've been building this 10-year lending model, which is based on if an entity or a person wanted to give out a bunch of loans, what does that look like as far as the equity needed? And what does it look like in terms of interest earned, any fees, like origination fees earned? And then when the principal comes back, the loans are done. Like, how does that look like if you're doing that every month for a while? And to do that, we did 3 different loan configurations. And you could have all or not, or 1 or 2 or 3, but essentially you could plan out um, a bunch of different average attributes about the loans you're giving out and see what all this looks like in terms of the lender. So assumptions you'll be able to determine are the loans added per month. You could change that each year. The For this one, it's an interest only period with a followed by a P&I period. So you'd have to determine how long the interest only period is, the average weighted average interest rate of the interest only period, the average interest rate of the P&I. And the reason why I'm saying average here or weighted average is because you're likely to have a bunch of different interest rates, but and it was too difficult to try and put. I mean, we've got literally 1, 2, 3, 4, 7 matrix tabs with 800 rows each just to figure this out, to make this work with these 3 different types of loans. So you determine some average stats about the loans you're going to be giving out. Obviously the loan amount, the term, and the origination fees. So you can do interest only with P&I, interest only, and that's it. Essentially, you're giving out loans for a set term and an interest only period. At the end of the term, the principal is paid back, and interest obviously was only paid during that time. And then P&I only loans. So this is like your standard, like a mortgage or something. There's no interest only period. It's just interest rate, a term amount, and any origination fees. And so all these things, I mean, debt is very complex to model when you start to get into timing assumptions and multiple, multiple, scaling them out. You could do any scale here, 10, 100, 1,000 loans a month. This could be a giant operation. It could be a small one. You could do one if you wanted to do one a month or whatever. It could also be used as a participant in a lending platform like Lending Club or something where you wanted to see if you lend out these loans over time, how does it look like for you? So a lot of application here. One of the most difficult models I've done, but I think this is super useful. And we're going to keep going on it here. So let me figure out where I'm at in this. So we've got the loans, the count over time, and the resulting lent amount, principal, interest, outstanding, origination fees. So what's next? I guess we do um, we aggregate all of this into one set. So let's go. This will be cash flow consolidated. And just add all these up. Real simple. We're done with all the super complex calculations. Pretty sure. Let's see, does that make sense? Lent amount, principal. Yep, so I think all three types can be described in total by just summing up each of their rows. Probably should aggregate the top part too, because that's going to be a useful chart. So let's go loans, consolidated. And then if you didn't know, this is also the time. If you've bought templates from me in the past from smarthelping.com or want customizations on something I've done or clarifications, this is the only time I'm open for free to talk about it and possibly do something that you or maybe build something new that you want to see built. If I'm not already doing too much stuff, I'll put it in the pipeline. Okay. Consolidated loans. Definitely do charts for all this stuff. Now we can start looking at revenue. So let's do revenue. I always like to do the aggregate of all the hard work. Now it's the fun part. So we want to say, trying to think if I want to break it out. I guess, type 1, type 2, type 3, total interest, revenue, and then type 1, type 2, type 3, total origination fees. Then we have a grand total revenue. So this will just be interest. So we want interest earnings, this, plus that, plus that. Wait. Oh no. We're just separating that out. So this, interest, interest. Oh, I don't want the total. We want the type 3. This, oh, that's the total. Then we'll take the total origination fees. And then the total of all of that is revenue. Which should match this plus this, which it appears so. 12, 14. So that's a nice sanity check there. So that's all good. Definitely be charting these summaries. All right, so we have no revenue in month one because because payments always happen after the following month after origination so as far as interest and principal, there would never be a month one. There are settlement fees though, so that makes sense. All right, I mean, this is cool. So we got loans added, all the cash flow that's going on with the loans consolidated. We have revenue. So now I can start actually building the business part of this. If you're just using this for personal uses, then you probably don't have expenditures and monthly expenses. But if you are running essentially your own bank, then you're going to have OpEx. So, and you're going to have all this other stuff as far as like startup costs, debt, equity investors. So let's do OpEx. And let me think about this. I want to make sure I'm not missing anything. So we've got all the loan stuff, revenue. We'll group these real quick. This could be grouped if you want, just to see all the consolidated only. Loans added that, and here's the revenue. Okay, so now the OpEx will be pretty straightforward, except I'm trying to think how there could be some expenses directly related to the loan activity for sure. Okay, but first let's just um, so I'll go in here for OpEx. It's pretty standard. I'll just take it from our enterprise SaaS one has a good setup for this probably. Yeah, this is perfect. So we'll take all of this. And paste that in here. Now, get all the references out. So we'll get a reference or fix the data validation. Um, what's going to be tricky is, are we doing any acquisition like cost to acquire a new lend or borrower essentially, which would mean is the platform doing advertisements or marketing to acquire, you know, and the answer is probably yes. You want to promote yourself as a lender so you can have people know about you. especially if it's a startup. Kind of curious why there were decimals in that. What did I do on this here? Oh, I got it. Yeah. In case it's like $1.50 for the cost of goods sold per active user or something, you want to have decimals in that, but the enterprise has a lot higher value number. All right, so we got all of this. Looks like it's referenced out good now. So the question is, we have our OpEx. Let's think about any cost of goods sold here, which would essentially be anything directly related to providing the service. And I believe this would be like web hosting for the platform if you are obviously a bank that has some kind of enterprise software. That's how you manage your customers. All the invoicing and everything that goes along with that will probably exist. Now let's think about if we can tie it to what's already here. So this is a percentage of total revenue. This could potentially be applicable, but this is a OpEx, or I mean a G&A, not a cost of goods sold. So for cost of goods sold, we're just going to do a raw, so this is just a raw dollar amount. And actually tier 1, 2, and 3 still makes sense. So like this would be the if you can tie your costs of goods sold directly to your customer count of tier 1, tier 2, and tier 3 customers, you can just list them out and it'll do that amount times the ending active users, which we have because we tracked the end customers as you go along. You start to add some, you also lose some. Eventually, here it takes, in year 6, we start to lose some as they repay their full loan balance. But the net ending number per month, you might be able to link a cost up to that. If not, let's see, do I just have a monthly amount? No, I don't think I did for that. So we can just do, cost of goods sold, hard coded. So, cost of goods sold 1, cost of goods sold 2. And this is just if you want to define a monthly amount. Let's just say, 1,500 a month for software. Or whatever you have. Just, it could be anything related to providing, servicing your customers. I'm not gonna put, so for, I'm trying to, so a lending company is a lot like a SaaS business in terms of customer support and sales are probably going to be scaling with based on how many customers are being added per month and the total amount of customers that exist. So, and I wouldn't classify that as cost of goods sold. I classify all that as G&A, but we probably need to define that separately. So here's, I think cost of goods sold is fine here like this. Let me bring back the enterprise model because in that one we also did cost of goods, or we did customer service by tier. Yep, this is exactly what we need. Because you're not gonna, like, if you're scaling hundreds, thousands of loans, you're not gonna know like manually how many customer support people you need. You're gonna need to do some math there, so that can be modeled in. And this will just tell you required customer support person per customer. So if it's 2, that means each customer support person can handle 2 a month. Normally, I mean, this is probably like 50, I don't know, 30. So for every 30 customers of tier 1, you every 30, no, hold on, wrong way. It'd be like 0.03, meaning each rep can handle 33 customers. There's salaries, fully loaded salary. Um, we also have other support if there's other type of support that you need per customer. Maybe this is a little bit. Maybe each of these can handle 10. We'll just do the same thing for all of them for now. But I think this is super relevant, definitely necessary to do for this type of business at scale if it's a bank or something. So these are customer service. And let's do sales as well. Sales reps. And I mean, these could also be sales, could also be like account executives or just people that onboard. And I'm trying to think about how did we, let's see here. So how, okay, I just did a manual ad per month. So what I'll do is in the summary, I don't want to directly drive the loan data per month by an ad spend amount because it could be ad spend, it could also be direct, organic. But what we can do on the OpEx and sales and marketing is take the total spend on sales and marketing divided by the new customers added per month, and that's going to be just our cost of acquisition. So all the spend on sales and marketing, including the sales reps, those will be in the sales and marketing. And then however many loans were added that month and then that's how we get it. So you kind of back into the CAC in that case. Welcome, one viewer. You're the first one today. Good to see you. It's a lonely life as a financial modeling streamer. Anyway, I'm just we're on building out scaled sales reps, customer service reps. We're trying to get all the OpEx built for this lending model. So again, sales require salespersons per added customer. Probably like each one can add 5 a month. Maybe it's And then other sales support, maybe they can do a little bit less. Maybe 1.25 a month. And this will be configurable for each type of loan, which are there 3 types. So the bigger this number, the less people that the type of rep can handle. The smaller the number, the more customers that they can handle. Sales reps will be based on added customers per month. Customer service will be based on the ratio based on total existing customers at the end of each month. So sales reps, customer service, OpEx. I think I could move this over a little bit. I think we've got all our costs ready to go. So cost of goods sold will be all of this. 1, 2, 3. Cost of goods sold 1, 2. This would be like software fees. And then total cost of goods sold. I'll have gross profit down here. All right, so we're calculating this by cost per active customer tier 1. So it'll just be if our date is greater than the exit month, then 0. Hey, viewer number 2, what's going on? It's a lonely life as a financial modeling streamer, as I told viewer number 1. What's happening? We're just in the middle of building some logic here. This is 0, otherwise index. And then we want this amount, comma, match, and I think E2 is the year with the year up here. So that's right, 5,000. And then we're actually multiplying that by the count of tier 1 users. Which is right there. Lock this up. And these numbers are high because I had it for some other model I was using on this amount. Let's just say it's like $100. Okay, and then we can drag that down. Index goes down, lock the date, lock the reference row, and then we got to adjust this for each tier. So this is tier 2, and this is tier 3. Now, why is that 0? 115, 16, 17. 115. Oh, gotta lock control number 6. There we go. All right, so that's going to be scaling with costs. We we can still drag, and then regular cost of goods sold is just referencing the number in 20 through 22, and that's a hard-coded value per month in each of the 5 years. So what was that? 120. I'm thinking about building a 3-statement financial model around this as well, possibly, which would be quite a bit more work, but it would be cool to see, I think, and useful. I don't know, maybe. It'd be a lot more work, but it might be worth it. So there's their cost of goods sold. We're now getting NA errors. Why? Oh, okay. Right, because we're doing a 10-year model. So extend these out 10 years. That's no problem. Column with 10. Eight. Now, hopefully, I'm not discouraging anybody who's looking into financial modeling. It's not that bad. Really, it's a dream. I love it. And if you're just starting out, just know that you got to keep working at it, and eventually it pays off. Just keep going. Keep trying to get more efficient. Leverage yourself into really good positions, and just keep learning stuff, and you'll be fine. And it's not bad. You get to do essentially whatever you want. All right. Obviously, it depends on the role, but you have a lot of optionality in what you do, and there's literally unlimited work out there. Okay, that looks good. This needs extended out 5 years. 1, 2, 3, 4, 5. Unmerge that. Dang it. There we go. 6, 7, 8, 9, 10. Okay. We'll go size 10 across. This can. So that's fine. That's fine. Let's go back over to our monthly here. And this should all be working now, which it is. That's good. Let's make sure if we put in some numbers for year 10, let's change it up. Make this 50, 25, 10, and make this 1,000, 50, 25. Make sure it's just picking up the right values. So cut in half, half, and that looks right. 660,000. Yeah, that got cut in a fifth. Yep. Okay, so that all looks good, and the numbers started populating in these two. Okay. So cost of goods sold looks good. Now we can do gross profit, which is just total revenue minus this. And this is obviously just a made up number. All my assumptions are completely arbitrary. My job in modeling here is just to make sure all of the math and logic works when you enter your own assumptions for whatever situation. I don't want to show a negative gross profit though, so I'm going to lower some of these numbers a lot. Or, I mean, we could raise this up to like 100. What would that look like? Okay, numbers are getting really big. Let's put this out to 15. Okay, because it's scaling with active customers. So let's say in reality the cost per customer to service is probably like around $1 or $2 at scale. Let's just say $1.50. Give these some decimals, and then we'll do 0. We already know those are working, and that's a raw amount. We haven't done this yet. We haven't actually put in any of the other OpEx stuff yet. Wow, still a lot. Okay, cost of goods sold 1. What is going on here? Oh, I'm multiplying. I shouldn't, so this shouldn't be multiplying by anything for these because it's just a hard-coded amount per month, not a scaled figure. And that's why we test things. Now, okay, that makes more sense. All right, so this is positive. That's good. Let's put this back down to 10. Okay, and still making profit. Perfect. So we have our revenue or our loan counts. We have all the numbers around cash flow. We have our aggregated revenue. We've now got cost of goods sold. Welcome, one viewer. It's the lonely life for a financial modeling streamer. Good to see you here. uh, we're just working on the lending model that we've been doing for 3 weeks or so. I'm down to actually gross profit, and I'm adding OpEx stuff right now. If we go here, we're going to just start down the line. So we'll do sales and marketing first. That doesn't matter. Drag this all the way down. So we got sales, G&A, and this. Now the easiest way, so we've got this drug all the way down here. And then before we add any other stuff in between, we can just simply go if the date is greater than the exit month, then 0, otherwise index, and just pull the numbers. Oh, and we got to reference this month start in case it's after that. So index this, match E2 with the year, 0. This is here, match this with this is locked. We do one formula and drag it all the way down, and it should match all the OpEx. This and this. Otherwise, we also got to say if, hey, viewer number 2, welcome. It's a lonely life for a financial modeling streamer. Good to see you. If this is greater than the start month, then zero that out. Or no, 0. Otherwise, if it's less than that, so if the date is less than the start month of the OpEx line item, then 0. Otherwise, if the date is greater than the exit month, then 0. Otherwise, index row 6, match E2, which is the year, with our year up top. Ah, I see. Should be row 3, actually. All right, we got a number. Now, I should be able to drag this all the way down to the bottom and over. So there's all our references, nice and easy. Now for this, so we got R&D, function total monthly revenue, which is normally just payment charges. So these are going to be multiplied by the total revenue. So times this, in case you collect your interest expenses via credit card, and you have to pay credit card fees on that. Is usually what that's for, and if it doesn't apply, it obviously can be zeroed out. Lock this. Let me make sure there's 5 here. 1, 2, 3, 4, 5. Yep. We clear out now all the blank stuff and then put in subtotals for each category. Clear, clear. So we've got, let's just reference this as the type, sales and marketing, G&A. Now these G&A, okay, so this is what we got to move first. 1, 2, 3, 4. So now that I'm moving this, you can't just drag one formula down, but I just needed it to get the initial formulas in here. So that's part of that. Let's make sure. Now, one test I'd like to do is just put each month offset by 1, and that lets me know for sure that the logic is referencing the right numbers correctly. Now the scaled costs, like cost of goods sold, it doesn't need a start month because it's just based on when there's customers, which has already has its own start month. Although cost of goods sold hard-coded costs will have a start month. So we got to update that real quick. Where are those costs? Right here, I think. Yeah. So this has to have another one on top saying if this is less than this, then 0. Lock that, lock that. Just make sure that's working if we just put some amounts in there real quick. Okay, 100. Yep, that looks good. Drag it all the way over. Perfect. All right. So we have cost of goods sold, references correctly. These look good. Now let's break out each compartment into its own subtotal cost. So sales and marketing, we simply go give this extra space. Total sales and marketing costs. Sum it up. This could just be top and bottom. And then so space, G&A. This will be total G&A, which is just general and administrative. Put that in there. Then R&D, which is research and development. Total research and development. All right, let's group all these rows up. Group. Do I need to title OpEx? I think, well, we got the side in the subtotal at the bottom should be fine. Okay, so we've got all the revenue. We've got, and I'll aggregate all of this stuff on a higher level summary so it's not super detailed, but this is the detailed version. Welcome, viewer. Lonely life as a financial modeling streamer, but fun. We're working on the lending model. Third week, getting close to being. Right now, I'm doing all the OpEx and all the costs, so we're getting close. I think we're actually up to Ebitda. Let's see. So total operating expenses. Got research and development, admin, general, sales and marketing. Yep, we're. And then next up is Ebitda. Which is just earnings before interest, tax, depreciation, amortization. Hey, literally the first comment I've had in the live chat since I started doing this for the last 6 months. Mr. Robot, you're the first. Yep, Microsoft Excel is what I'm working in. It's how I make a living. It's fun. Gross profit minus operating expenses. And we're all the way down. Hey, you too, Mr. Robot. We're hanging in there. Ebitda. Okay. I mean, we're getting there. Oh, shoot. We got to put in customer service and sales reps, which would be G&A. Yeah, that's a big cost. Let's see. So, well, the sales is in sales and marketing. Let's do that one first, which we're going to have 3 slots and 3 for this one. And then at the end of the day, figure out if we're profitable. Hey, got another viewer. Welcome. It's a lonely life as a financial modeling streamer. I've been telling everybody that today. Good to see you. How's it going? We're battling in Excel here, working on a model for lending. Currently populating customer service and sales rep scaling costs. All right, so for customer service, we're doing it based on the total ending customer count for each tier, and then based on some ratio of required reps per customer, we can figure this out. So let's go down here to do this. So customer rep count, head count, tier 1, 2, and 3, and then we're also going to have sales rep count, tier 1, 2, and 3. So the calculation is simple. We do equals total tier 1 customers at the end of the month, which are just borrowers in this case because lending model, divided by, and then we want to pull the customer service count. So let's see, if we had 10, each one can handle 33, so we actually only need a third of one. So we just do, let's think about this, 10, I guess we do the count times, so not divided by, we want to do multiplied by, times required customer support, match with the row, or I mean the year, and here's the year, and 0, and I think that's actually it. And then we multiply by the fully loaded salary per year after that. So let's make sure this makes sense first of all, and let's lock this, lock this, definitely lock this. So we're saying if we have 10, and then this is 17 and 23. 17, 23, and then this is going to be row, let's see, we have actually got 2 types. So we got to go, there's actually 2 types for each one. So tier 1, type 1, 2, tier 2. This is what it's like creating a masterpiece, man. It just takes time. It'll be worth it in the end, though. You feel good about it being done right. Tier 3, type 3. Okay, so let's just make sure the first calculation is right. This is going to index only tier 1 customer count, and then this is indexing 7, and then this should be indexing 12. We got to make sure this actually, I did the right math. So it's easier to see when there's more numbers, so let's drag this over, or higher numbers. So here it's saying we've got 660 tier 1 customers, 660, and we're saying each rep can handle 33 customers. So you divide total customers by this equals 19. Okay, so we got something wrong. Let's try the other one. 660. If there's 660 customers, you've got, for other support, we're saying each rep can handle 10. So total customers divided by this equals 66. Yep. Okay, so this is the wrong math. We need to actually divide. See if this makes sense. Divide by, and then go one row down. Wait. What is this, bro? This is a financial model for a lending company or somebody who wanted to participate in a like lending club where you're lending out money and you collect interest and principal over time. Or it could be for a bank that's lending out, making loans. They got to figure out how much money they need, how much, you know, revenue they might make, cash flow, all that stuff. And right now, yep. And right now I'm trying to scale out the customer reps required. And I'm scaling it based on the customer counts. And right now, this math, I'm missing something here. Oh, cool. What are you working on? Divided by 12. Okay, that's definitely not right either. Let's think about this. If I've got 660 customers and I'm saying each rep can handle this many customers, so it'd be the count divided by 8 and 13. So count divided by 8 and 13. I'll tell you, it's very difficult sometimes when I'm talking and trying to do this. It can get very difficult. Okay, so this is the same number as this. So what the heck did I do over here? So this would lead me to believe I did do the right math, but I'm not sure. So I should have 25 people here because each person can handle in the type 2 10. Oh, so that's what in the oh shoot. See, I'm using year 1 numbers, but I'm in year 10 on my test, which is there's an improvement percentage. So I'm doing a check on the wrong numbers. So 660 660 divided by this. Yep, okay, that's the right number. 660 here divided by this And the reason why there's a percentage improvement in here is because we're assuming that people get more efficient over time. There's just efficiencies that happen. All right, 7.7. Okay, this math is correct. Now let's just scale it to the other stuff. So tier 2 here and here. Yep, so VLOOKUPs, I stopped using those a couple years ago for a lot of these calculations because they break very easily. And in index match, you can just reference a row, and if the user moves rows around, it doesn't break the formula. It's just a little bit less easy to break than using a VLOOKUP. And then if any of the columns change, you're going to get an error. And I just had so many people having issues with that, so I just changed everything to index match. As far as these VLOOKUP still, I mean, it's still super useful, and HLOOKUP as well, but for this, I just found the index match resulted in less errors for the users. And also, if they change like the text on the left hand side, the lookup is then broke. No problem. Understood. It's fine. All right, where are we at in type 2? So type 2 is here, and then all I'm doing is let's see, did I divide? No, I'm multiplying. So we're doing divide the count times 20 and 25. Okay, we'll check this one, and then finally this will be tier 3. And that's 32, 37. Now this model, I have matrix tabs to figure out the loans. The lending logic is always so difficult and this is actually the first model I figured out how to scale it properly. I've got 800 rows worth of logic for 1, 2, 3, 4, 5, 6, 7 different matrix tabs just to account for 3 different loan types. Okay, let's check these numbers. So 36 here, and by year 10, we're at this account. Okay, that's right. Let's do the other count. 4.2, that's correct. Check this one too real quick. Type 2. 1.28, and then let's do the other one. So much sanity checking on this stuff too. Where was I? 0.38, okay. So it looks like we're getting the correct head counts. Now, sales reps, so same deal. Except sales reps are going to be based on customers added per month. Borrowers in this case. 9, 9, 15, and 21. So we'll go 9, 9, 15. And I'm thinking about doing a 3-statement model with this too. I don't know though. We'll see. It's going to have already the income statement and cash flow kind of built into this already, but we'll see what happens. All right, so different tabs, sales reps. We want the number divided by 8 and 13. So that should already actually be the right reference row because they're the same. Oh, what did I do? Okay. Drag this over and make sure this is correct. So added is 10, 11, and 1. Okay, so for this one, we're adding 10 divided by so less than 1. Yep, that looks good. 3.1, perfect. Let's test this tier 2. This divided by tier 2.85. That's good. Divided by this one. 341, that's good. And finally, tier 3.08. And decimals are completely fine. Divide by this. Okay, that all looks correct. Now I kept the reference to customer sales for the year because these are identical. They don't change, so that's not a big deal. Now we calculate the cost. So where am I? We'll do see you later. Take it easy. Yep, we'll be at it every Tuesday. All right. I need annual salary. Oh, man. All right. This has to be separated out too. So salary CS1, salary CS type 1.1. So we simply go the count. Sometimes it is easier to break everything out into its own row so you don't have to put too much into one formula. So salary CS type 1 is just equal to the count times index fully loaded salary match E2 with the year up here, comma 0, and then divide that by 12 because this is monthly. So index, that can go down, this moves, this does not, and this does not. So this moves, so you got 1 here, and then we go CS1 is now 15. And if we keep dragging ourselves down here, type 2, and then we'll go 22, 27. And then we go 34, 39. So that's the total monthly cost for customer service reps for each type of rep. Drag that over. So let's make sure that makes sense. If you had 25 here, they're all making at the end of here 40,005. Oh no, that's the second one. This times 35,000 divided by 12. And this should equal this. True, perfect. Okay, sales CS. Now let's do, or that's customer service. Now let's do sales, and then we're done with this. Replace CS with sales rep. And then now interest, so we could take, so this actually all lines up here because I just took the same amount of spaces. And then all we have to do is change 1823, change, and I think we can do a find replace on this too. So CS is going to become sales rep. Shoot, that's not what happened. CS sales rep. Now why doesn't that work? Sales rep. Oh, I put an S in there. All right, hold on. Hold on. Replace CS with sales reps. It's the S. Okay. Now, why is this 0? Should not be 0. 2 times 18. Oh, okay, I didn't lock it. Okay, so this has got to be 10 and 15. 10 and 15. 22, 27. And 34, 39. All right. So what I'm gonna do is we can now just pull up each of these rows. Total total CS salaries. Total sales rep. Drag this all over. Now, okay, so at the bottom of sales, we do total sales rep salaries. And obviously, if your situation is different and you don't need to even have these, you can just zero it out, and that's not a big deal whatsoever. Let's make sure this is coming down. So sales reps, we just reference right here. And customer service reps, we're going to put in here. And that's just equal to what we just did down here for CS. And yeah, we're already getting the little load formula when we save, so this is a bit bigger template. Not that bad though. Group this, group this. And then if we wanted the total count of sales reps, total count of customer service reps, we just sum all that up. And that will probably be in a chart. Because at scale, obviously the other stuff on like VP of marketing, managers, all that stuff is kind of manual. and there's just one count, so it's not really a big deal. But the stuff that scales out, which is going to be your definitely your sales reps and customer service reps, should be you might want to see that in a visual. Let's make these even smaller. We're actually going to just do we're going to zero out the secondary ones. And I'm almost guaranteed we're going to have a net loss in Ebitda with these numbers, but again, it's just literally random, or it's arbitrary, it doesn't matter. It's just whatever I'm putting in here to check all the logic. Okay. We could do if error, zero this out. Probably need to do that on all of these. If error, or okay. And then, okay, so I'm trying to divide by zero here. So actually, it doesn't matter what I do here. I could put a really small number, but really what should be done is if error in front of all of these. If error, then zero. If error, then zero. So then the user has the ability to zero stuff out that they don't need and it won't mess up anything. Because if I sum up this, yeah, it won't sum it up. No. I think I just need to do it on the counts and it would be fine going forward. Now, if I were multiplying, it would have been okay. But if I multiply by the other part of the ratio, the top half of it, but because you're dividing, you can't divide by zero. Okay, so let's drag this over. Format it. Perfect. So we zero out the second hat or second type of each rep. Now that I just found that, I need to go over to my enterprise model and make sure I do that on here because that logic was from here. So if I wanted to zero this out, yep, that's error. So we need to do if error this. And put that on all of these. Make sure. Okay, these counts. So let me go up on this model. I must have done multiplication. Yep. So see if you multiply here like I did, I multiplied by the top ratio instead of divide by the bottom half of it. It works fine. So let's save this just so I have it. Welcome, one viewer. It's a lonely life as a financial modeling streamer. Happy to um, have you though. We're just working on the lending model. We're getting through almost to Ebitda, getting close here. I just did this customer service and sales rep scaling. What fun that is. Okay, so sales rep. We had our first person talk back in 6 months of streaming, so that was fun. Mr. Robot up there, you can see in the chat. It's a milestone. Okay, so that's going into here. Fine. This, I'm gonna drag this all the way down. Okay, so yeah, we're operating at a loss here. And then, oh, profitability happens. That means we've added enough loans where it's stabilized. Yeah, that looks pretty good. We'll keep that how it is. Okay, so holy cow, we gotta hide all of this stuff. Because it's right in the middle of our stuff here. Group all this. So customer headcount, sales rep headcount, salaries. All right, welcome back, viewer. Good to see you. How's your day going? We are just plugging along, myself at least, here. All right, so we've got all the sales rep, we've got all the customer service stuff. Oh, shoot. Gotta put if errors on this one too. If error, if error. I guess I didn't need it here if I also put it on the detail, but put it here too, it's fine. Oh, and I guess I didn't really need it on the enterprise SaaS since it was doing multiplication. Let me make sure though. Actually curious. So on this is where I got the logic for that. So if I plugged in a 0 for this, does it mess up all my stuff? No. It does not because I'm using multiplication instead of division. Where's my customer service reps here? So it zeroed out tier 2. Yep. Okay, so actually I didn't really need to do that update on the enterprise SaaS anyway, because it's fine. Sometimes multiplication is better than division, if you can do it or manage it without messing anything up. Okay, so on this one I did division, so I had to do the if error. Let's go to CapEx, I guess. I'm gonna spread these back out just for now. And then we'll get down to cash flow, which is going to be real fun with these lending or loan facilities. All right, CapEx is real easy. We'll just do reference these. Total CapEx, and then this is just going to be real simple logic. If our month here equals our month here, populate the amount here, otherwise 0. And then we lock ourselves going down, we lock on OpEx going sideways, and we lock the amount going sideways. When we get down to cash flow, that's when things start to get complicated again. Right now, today's been mostly just doing OpEx stuff, which is not too difficult for logic. If you haven't seen the last 2 weeks, we did all the loan logic, which I've got literally 800 rows of stuff I had to do on 8 different tabs to make it work right. And there's no other way to do it, I don't believe. Lending loans, when you have timing assumptions around them, always get super complicated. And at scale, because you've got principal, interest you need to track. I've got interest only loans, interest only, and then principal after that. So it's just a lot of stuff. We're going to rename this just cost. And we could probably lock this, freeze this. Okay, so CapEx looks good. Now we have see now debt service is so you can have debt service with a bank because they might be borrowing from other banks, I guess. We'll put that under this. Startup costs here. And note, this could also be used as a person that's participating in a P2P lender like Lending Club or something. And you would just zero out all these costs, and just essentially all you're doing is figuring out who to give money to, essentially. Startup costs, and now this. So if the bank is getting a loan from a bank, we have to do a debt tab. It's most likely these things are done with equity only, but you never know. Let's just put an option in here. So debt, we'll pull up our good old lending model here, or enterprise model, because it's got a debt tab. This is just a regular amortization, as if you're taking money from a bank. And this is just based on control tab. Debt proceeds, if applicable. Okay. Well, it's only 10:39, so I'm actually making very good progress here today. Streaming every Tuesday morning at 9 a.m. and we are making progress. I think this template I'm gonna sell for $125, one-time fee. I believe that's, or actually, you know what? I was thinking about lowering it to 75 based on the expected interest in the model and the complexity and difficulty to duplicate. I think $75 is probably fair. All right, that works. So let's just say the bank needs money to start their bank, which I'm pretty sure does happen. Um, one, two. Oh, come on. Come on. Copy and paste. Now, I will be rolling all these high-level line items into more formal statements at the end, but the monthly detail is essentially exactly what you see. It's the detail of all the different things and based on the assumptions. Principal, interest, and then if there is an exit assumption, assuming you sell the business for some amount of money, if there's any debt left at that time, based on whatever terms the loan it is that the company has taken out, um, that will be automatically paid off at upon exit. Come away from that, it'll be taken from the exit assumption or terminal value. So, I mean, essentially, what you're doing is saying, okay, I want to borrow money from a bank, and then I want to use that money to lend out to other people, and you want to collect fees and interest that are higher than your initial loan. Is why I guess that's why you would want to borrow money. So principal, if the month matches our month. And we lock all these columns. Lock the month as well. Oh shoot. Oh yeah, we got year zero here. I was gonna say we needed year zero. I guess we can bold this. And then interest was row C or column C. Debt service, and then debt proceeds. So whenever this money comes in, which is always usually going to be the year zero, but it might be later for whatever, who knows why. But this is going to be if the month here equals the start month here, then money coming in. Yeah, doing a balance sheet on this stuff, I think it'd be kind of fun, but it definitely is going to be a puzzle. And I probably would use my three statement model I've already done as a template to build it into. And there's no inventory, there's no accounts payable receivable, so I think that would work. I think it'd be actually not too bad. Just trying to think about all the aspects. Yeah, actually, this wouldn't be too bad at all to put into a three statement model. Now that I think about it. E4. Make sure that proceeds. Just make sure this works. Let's go out a couple months. Okay, good. And this is assuming whatever month you get the money, your payments start the month after that. I think. Let's see, is that true? Yes, so it's always offset by 1 month. Okay, so we got that. And we can group these. So if you group everything up, it's actually not too much. You've got your loans, you've got all the cash activities from all the loans, revenue, cost of goods sold, gross profit. We'll put a gross profit per margin in here. This divided by this. And then we can also do net profit margin. Where did I put Ebitda at here? This divided by 71. %. Hey, welcome viewer. We've had a lot of viewers today, trickling in and out. I guess I can't say it's a lonely life for a financial modeling streamer now because I've had, you know, I don't know, maybe 5, 6 people in and out today. It's a lot for me. What's going on? We're working on the lending model, if you didn't know, and I'm actually down past Ebitda, CapEx, startup costs, debt proceeds. I'm getting to cash flow, which is close to the end. This has been the 3rd week we're doing work on this model, and it should be done soon. All right, cash flow. So, oh no, actually we need to do terminal value. So terminal value on this, let's think about this. If you've got a bunch of loans, I feel like this is not going to be as easy to calculate. I mean, let's think about this. What would someone be willing to pay? I'm actually gonna have to look this up. I have to look up how to value a bank. Valuation multiples. So the 2 key valuation multiples for both banks and insurance firms is price. Obviously, we don't have a market price. Book value just means shareholders' equity. Oh, shoot. Interesting. Most banks, insurance firms are worth about as much as their shareholders' equity. So assets equal liabilities plus owner's equity. So it's essentially saying it's worth its net, but assets minus liabilities is what it's worth. Interesting. Well, some analysts adjust PE for non-recurring items. Yeah, goodwill. All right, so what we'll do is the valuation is gonna be terminal value based on the net assets times some multiple, which it appears to be around 1. Now the question is, we're gonna have to build a three-statement model to figure out what the net assets are. And I guess it's what you have in earnings and assets less what you owe if you owe money, and then I guess what people owe you would also be a, so how would that, I guess it's accounts receivable, like a loan, like if somebody owes you money, that's their accounts receivable. So essentially they're paying for the value of the receivables plus less if you owe any debt. All right, we're okay. So terminal value is going to have to wait. This is actually going to be difficult. I haven't done much work with banks, so I don't know. This is my first real. Now, obviously, if it's just someone on a lending platform, you don't have a terminal value. But if you are a bank or a lending firm, investment bank, something like this, you would have to. You would. Oh, and I got to think about if I'm categorizing things correctly on the three-statement model, because we do know the total amount of loans that are owed at any point. We've done all the math and logic on that. We know how much debt is owed, which would just come off of the terminal value. Now, if we're I guess the only thing is if we're assuming that any net profit or net cash flow available is distributed to investors and owners, then owner's equity would essentially be the value of any loans that exist, less any debt. So and I think I did this in the three statement model where there's an option to pay out dividends or not. Okay. Anyway, this is going to be a yellow because this is something to be determined. So outside of that, let's do cash flow. So we can do cash flow and I don't want to do any taxes. So this is going to be, I will allow for a row to manually enter taxes. On when I get to the annual detail, you can put an annual number and that will populate this monthly. So we'll have, if we're going to do that, then I'll just do cash flow before taxes. And then and then there's so many different variations with taxes. It's just easier to have it be a manual input by the user if they want to account for taxes in the model or not. Taxes, like income taxes or whatever. Taxes, cash flow after taxes. And this will be defined on the annual detail tab. This cash flow after is the final number. And I will have to have, so we need to add before we get into this. just pull this format over. So this is a big one, cash flow from lending activities. And this would be loans given out, or however you want to call it. I guess loan disbursements. And then loan repayments collected. Now, question here. We just do a net cash flow. Question is that I need to think about is defaults. So, did I put anything in here about defaults yet is my question, and I did not. So that's something, and all that's going to be is a percentage of all principal repayments, and if it's like a 3% default rate, it means any money collected, you actually only collect 97% of every dollar if default rate is 3%. So it's actually not hard. I'll put a default rate on each of these types, even though let's see, well then I'd have to know. Let's just do, no, we don't need to do that. We're gonna say on the control tab, average default rate is just gonna be a one aggregate figure. Let's just say it's 2% for this case. And that would be counted as an expense. Let me see multiple. So this is going to be based on value, based on owner's equity. I think, is that what share? Shareholders equity. I'm just going to say based on net assets. Because if you have like retained earnings of, let's say, $1 million, I guess it's a one-to-one. So based on net assets, based on share, based on let's think about this. Assets. Yeah, net assets. Because that's equity. Assets minus liabilities equal equity. Or assets equal liability plus owner's equity. If you subtract out the liabilities from assets, it equals that. So that's what the multiple is going to be based on. Okay, default rate. So we just have one rate here. We're going to count this as a general and administrative cost. It's going to be right here. Defaults. And it's going to be real simple. Equals total principal collected, which would be this plus this plus this. Actually, we can just do the consolidated number, which is this. 387. Let's make sure. 3, 4, 5, 15, 565, 15, 35. Okay, 6. So it looks fine. Equals that at times default rate here. And that's it for this. So that's an expense. And that would be applicable to if you're on a lending platform or just a bank, whatever. It's not likely that you'll collect 100% of your repayment, so some percentage comes off of that. So now we say, so that's accounted for. So when we do loan disbursements and repayments, since we've already accounted for the defaults and the expenses, we would just say whatever is collected here is the full amount that should be collected, and then because we're subtracting out what's not collected. Because in these formulas, let's see, principal, loan configuration. Just want to make sure origination fees, payments. Yeah, I don't have default. I just want to make sure I'm not double counting the default, which I'm not. So let's get back down here. All right, so loan disbursements would be loans given out. This amount of money. So to give it out, you have to have it. So you need 415,000 there. And collected amount. Be consolidated right there. So 54.55. And that's just the total. I also want to test, make sure this is working. Let's do exit month. List. Here. Let's say second to last month. Scroll over. Okay, so we got to update that logic. 0. We got to update some logic here. Yeah. So if this is greater than our exit month, then 0, otherwise that. And we got to do this for all of this stuff. So copy that. This is just, wait. Put this in front here. So that's that one, that one. That will be 0. We need to do of this as well. Well, hold on a second. Let's do these. So we know that should be 0. That should be 0. Now, I don't know. We kind of want to know the outstanding loan amount in this month, even though it's an exit. Oh, but if it's after, so exit month here is in this case November, so this all should be zeroed out. Yep. So let's get that up there. So this is all zeroed out. That'll all be 0. This should be zeroed out. And this is the logic we got to do to make it flexible enough to have a variable exit month. It's here, here, here. All right, now I believe that can all just be drug over. Dang it. What? Why? Ah. Okay, so total outstanding amount cannot be drug over because it's a different formula for months 2 through 120. So let's get all this over here. Make sure nothing's changing. Now, perfect. All we should see is a 0 out in the final month, and everything else should be the same. Okay. And whatever, that's fine. So this is all zeroed out. There's no revenue. That's good. Cost of goods sold, that's zeroed out. OpEx is 0 because I already actually put that formula. Oh, thank goodness. I already did the formula for the control for all these OpEx stuff. So that's great. Um, Sales rep salary. So we got to do it for that. Now why? Because we still have these. I only zeroed out the subtotal, so all right. Well, I guess the easier way is to do it from the top. So let's just make this. Obviously, you can't add loans if you're not in business anymore. So zero this one. And that one and this one. Drag this over. No, 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 no. What did we do? undo, undo. So why in the world is this, why did this get messed up? Okay, that's not even working here. What is going on? All right, I have no idea. Let's undo, undo. So question is, okay, why is March different? Let's drag this over again, see what happens. Okay, that's fine. Now, why can't I wrap this around here? So if this is greater than this, then 0. Now this better work. What is going on? What is the error? This is a number. I don't understand how adding this even does anything. Principal balance. Oh, I see. The last monthly cohort is giving a blank because it's 0 and it can't look up. Okay, okay. So, okay, that's fine. So we know that. So let's undo this. You don't got to be nothing. We'll just keep that like that. And let's just go. It'll be a lot easier in this case to adjust the sales reps instead. So let's see, they were first. If this month is greater than our exit month, then return 0. Otherwise, that. And then all I think we got to do is the debt stuff. Yeah, 0. Okay, perfect. That's fine. So their sales reps are 0. Okay, that's fine. Now for this, if there's our formula. So for this, no payments. after the exit month. And then now debt proceeds, I guess we need debt balance here, which is just equal to, here we can do a VLOOKUP equal to, or we'll do an index actually. And all I want to know is the debt balance in E if the month matches here. 0 for exact match. Okay. Lock. Lock. Come over here. And it looks like we're for sure going to be going into next week on this model, which is fine. I'm not really in any rush. Now, wait, 10-year loan. Let's make this a 30-year. So we got to add this to it. And then, so this is no longer active. And then if this debt repayment, we do, if this equals this, then we got to pay that. Whatever the balance is, gets paid back. And then terminal value, we're going to say, actually, no, we're going to say this is sales proceeds from exit. Because actually the terminal value is kind of the net cash flow, which we're going to say, well, let me think about this. So no, we can do terminal value, which is going to be, you essentially zero out all the assets and liabilities and subtract out, and so that'll be part of this debt, and then um, that will be whatever the terminal value ends up is, and that's the cash. Yep, this be, so that's going to throw some wrinkles in the three statement model, but we have to do a three statement model for that to work. So we will. Okay, so that's fine. Let's drag this over. Loan activity. Perfect, that's already zeroed out, that's good. So you're lending out more here, so net, whoops, the net is actually what you're giving out minus that plus what you've gotten paid back. And this negative essentially just means that you're still growing, which we obviously are because we're adding loans every month. All right, now we can get to cash flow. So cash flow, and this is different from net income or net operating income or anything like that. This is raw cash flow, and then taxes are going to be a hard-coded input, and then cash flow after taxes. you can derive taxable income from everything I'm doing here, but there's just so many variables with how taxes can be calculated. I'm just having it be its own raw hard-coded input that the user does. All right, let me just, all these are cash. So Ebitda is a cash item, and then we want to minus CapEx, startup costs, which I got to drag these over, debt service. You want to add back in debt proceeds minus debt repayment. And actually, the debt repayment is going to be part of this terminal value. So let's just add the net terminal value here. Because terminal value is going to be, we'll get into that further when we get into the three statement. So this, and then obviously minus loans given out plus loans collected. And then cash flow after taxes, just this minus this. So we drag that over. Let's adjust this real quick. This needs to be over here. In year zero stuff. And then this is just summing up. Okay, drag this over. Now, so what this is saying is you're making a profit, but your EBIT is positive, but you're lending out in this case more. Your EBIT is essentially not covering the working capital. So if you went in this case and went cumulative cash, let's put this in here. I don't even want to bold this. This is going to say some big number you need to actually fund all this. Yeah, 60 million. Now, so growing more and more, you're creating a profit, but you're also adding more, um, you're requiring more equity to keep growing. I just want to make sure and think about this terminal value. So let's say we're on this exit month here, and giving out loans, just assuming the exit is at the end of the month. So we gave out loans, we collected some money, made our monthly revenues from interest and all that, paid out debt service. So if we sold, if the company is sold, then we're essentially turning that net assets into cash, and possibly some by some multiple. So it could be a little bit higher. So you repay that. They take on all the receivables. Any equity that's in the company, they get like net or retained earnings. Essentially, that's just paying for the cash. Terminal value. Uh, so that terminal value, I just don't want to double count anything is what I'm trying not to do. And I shouldn't be. So that's all independent of, and then let's say if they give that, then we just zero all those accounts out. We're paying back this debt if there is any left, and that's part of the terminal value. So that becomes cash available to distribute minus any taxes. Okay, I think we're good there. This is just some positive number less this debt owed. Okay, now how do we get to, let's think about this, loans added. What are the terms here? I'm trying to just make the assumption so we get a positive cash flow. So these are 5-year terms. So here I made them 0.25. That essentially means it's a 3-month term. Which decimals will work? Let's just change to 1 though. These are 3-year terms. Let's just say 2. Let's keep this the same. 10 and 1. Might as well make sure this is working. Start February, March. Oh, we got an error, so that's good. So something is not working. Let's see what it is. Interest. So B613. Principal balance. Oh, is this okay? So this is good. So it's saying let's actually start all these at month 2 and see what happens. Because it's an error. It looks like it's an error with not no loans in the first month, which is definitely possible that could be how you structure it. So wait a second. Wait, how is it? Is it not an error now? No, there's still. So this is where you get into the puzzle making or puzzle solving, which happens a lot in this kind of work. You better be good at puzzle solving. Right now, I'm trying to find where my error is. Okay, yeah, principal balance. So let's do, can we wrap the first one if error? Can we wrap that in if error? Does it work? Did for that. Now these are all the same. Looks like it's for the, I think this is principal and interest. So right, this should be 0 because there's no loans added in the first month, so month 1 cohort is 0. And nothing else changed. There's still an error. interest. So let's just do if error on this. And these are irrelevant. There's never, obviously, you can't add a month 5 cohort. Month 1 doesn't make sense, so that's fine. Let's do this. And we can make sure this is working okay. I guess we got to do this on all these. So if error, throw 0. Payment. Now what I'll do to test this is we'll simply first make sure we don't have any more errors. Okay. So to test this, I want to put one loan in for the first month. Starting loan count 1 for all of these. 1. Let's go to the monthly detail. So we add one loan here, an interest only. We lend out 15,000, so that makes sense. Interest starts the next month. What's the interest term on this? 1 year. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 12. So that's the repayment of 50,000. That makes sense. And you're charging interest. And we can actually, if I want to see this play out, I can zero out these and just look at one loan just for the fun of it. Okay. Another error. That's good to know. We'll have to fix that. So now where do we got an error? Seems fine. It's probably something referencing a blank. I'm sure. Let me see if it helps to make one of these 0. First, okay, here. Okay, so it's just, I just need to drag that down. Okay, so that's good. Let's go back. It should be fine now. Okay, so we're just assuming we're doing one loan of each type. So the first one, 15,000 is lent out. Repayment start 1, 2, 3, right? Because it's 3 months of interest only. Let's say we did 4 here. It should be then 4, 1, 2, 3, 4, and then we go P&I. Start paying that back. So that looks completely good. That's all working fine. At the end of the term, year 5, we start to add more because I just didn't zero it all out. Yeah, I started adding 10. That's fine. So that one looks good. Just making sure all this makes sense as I change the start months. Cash flow 2. So this is interest only for these types. So 50. Then you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And payback, that looks good. And then here's just P&I. So you got the loan, you got P&I for the term. And then what's the terms on these? 3 years. So, well, yeah, this should be paid off at the end of year 3, which it looks like it is. 894. Oh, hold on. Let me zero out one more. Let's make sure this is right. So we'll zero out one more year just to make sure. So there. So some of the principal is in that final. Does that make sense? So we're starting here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 36. Yep, 36 months, 3 years. Perfect. Okay, so that, awesome. It's all working. That's really good news. I think I'm about done for today. Happy to see some people coming in talking. First time that's happened in 6 months or 5 months since I started. I stream every Tuesday morning at 9 a.m. EST, Eastern Time. Come in, talk, give me suggestions, possible future models to build. I'm open to it all. Subscribe to the YouTube down there. If you want to check me out and buy some more templates, go to smarthelping.com. I've got over 100 models of all kinds of things, joint venture, a bunch of different industries, a lot of SaaS stuff, inventory tracking, forecasting of inventory, accounts receivable and payable tracking, all kinds of things in Excel and Google Sheets. As for this model, I think we're good to go. On the P&L. Next week, I'm going to do the annual, and then I'm going to start on a 3-statement version. Now that I'm sure all of this works, which it appears to be working great, even as we change the assumptions or the start months, which was important because I know the timing and there's a lot of logic in the timing of how things happen. So we got that all ironed out, and we're getting there. We're getting there. All right, I'll see you guys on the next one.